Nick Clay, why our defensive fund has outperformed rising markets in the period leading up to the financial crisis. The BNY Mellon Global Income Fund outperformed rising markets. It was overweight Asia and emerging markets, financials and mining, cyclical and pro-growth stocks. In the period between launch in November 2005 and the collapse of Lehman Brothers in September 2007, the fund returned investors 29.1% compared with 16.1% in the FTSE World, according to FE Fundinfo. Then as we got into 2007, we saw the writing on the wall about the financial crisis. We changed the portfolio quite dramatically, from overweight to underweight financials, manager Nick Clay, pictured, says. We started to dial down the cyclicality and pulled out of the emerging areas, to the point where we had a portfolio that did the opposite. That defensive positioning, which was fully implemented by the end of 2009, has remained in place since the crisis, meaning the portfolio tends to underperform rising markets and protects on the downside, depending on the nature of the market rally. In the 14 years since launch it has returned 308.9%, compared with 253.4% in the benchmark.Quantitative. Easing throws around fund betaQuality at a reasonable yield is how a recent presentation slide describes the £5.7 billion UK-domiciled fund, which dropped the Newton brand in September as part of BNY Mellon Investment Management's rebrand of £27 billion worth of funds.Before 2007. The fund had a beta greater than 1, which remained fairly constant, but Clay says that figure is now whipped all over the place, depending on what's driving markets. The beta was 0.85 in the September factsheet. I don't tend to look at the beta of the fund as it doesn't tell you anything constructive in this environment, because the market has been manipulated by it for so long, he says. If it's an exuberant, risk-on market, the fund underperforms, but it will outperform when bad news gets the market excited about central bank stimulus, he says. When yields are collapsing to zero in the bond market, we will outperform even though the market is going up. Nick Clay's sell discipline. Although the fund dynamics have changed since launch, a strict buy and sell discipline remains, although the thresholds have shifted. Since 2009, the investable universe covers stocks yielding at least 125% of the market. These are sold when the yield matches the market. The current yield on FTSE World is 2.6%, meaning anything in the portfolio must yield 3.25% or above. This results in a choice of approximately 750 stocks, a figure that has remained relatively constant. Before 2009, the fund targeted stocks yielding 150% of the market and sold them when they hit 125%. Those parameters were initially put in place because it resulted in a fund yield of approximately 4%, which Clay deemed sustainable. However, double-digit market falls during the F. For more on this story, visit the news article link.